Welcome back, everybody. The global economy has changed significantly over the past decade, and there has been a lot of talk about shifting investments from US to European stocks. But I have found that the reasons why are often short-sighted or misunderstood. The super investor Ray Dalio recently released a paper where he discussed the facts and statistics on this. And when digging a bit deeper, I actually found quite a bit of sometimes very concerning research. As a physics engineer, I'm a sucker for scientific facts and statistics because they help me to get a better grasp on such complex topics. So in this video, I want to share what I learned to also help you with your investing strategy for the next decade and give you more confidence with your decisions. I am Florian. Thank you for joining me today. The problem we face as long-term investors is that the future is fundamentally unknowable and unpredictable. Forecasting economies and markets is notoriously hard. So much so that most professional investors are not able to beat the market over the long run. But as investors in individual stocks, whether we like it or not, the only thing we can do is to take a swing and make a prediction about the future based on our experience from the past. And Ray Dalio and his team from Bridgewater did exactly that. They have looked at the performance of US equities over every possible 15-year time period since 1970. The picture they got is pretty confusing at first glance. But the important line here is the blue marked line, which represents the most recent 15-year period from 2010 until the end of last year. During this time, US stocks produced 12.2% annual returns. This is more than double the average return of 5.9%. So everybody who was invested in the last decade was pretty lucky overall. But I recently noticed in discussions with friends and colleagues that this has also skewed the expectations for the next few years pretty much. Some people I've talked to even think that a yearly performance of under 20% is pretty low for the overall stock market, which is just plain wrong, as we have just seen. In fact, over a very long time, even the S&P 500 returned just barely double-digit returns with 10.13% when we assume that all dividends have been reinvested and without taking inflation into account. That has also left investors, including me, very bullish on stocks and has led them to disregard other investments like gold or real estate. By now, US households have more than 80% of their assets in stocks. And of this amount, around 70% are in US stocks only. This is a higher percentage than we had even at the peak of the dot-com bubble. But the global economy has changed fundamentally in the last few years following the pandemic and the wars in Ukraine and Israel. As a result, the expectation is that the inflation and interest rates will both stay higher and more volatile for the next decade. This doesn't mean anything like the extremes we had in the 1970s, but a return to more normal levels. The professional asset and wealth manager Rathbones projects that the interest rates in the US and UK will be higher in the next decade than they have been in the last, but not dramatically so. The same is true for the inflation, that also should be a bit above the levels that we saw, but also not by too much, maybe except Japan, where they expect an increase of around 1.5%. But then, in this case, the last 10 years have also been even below the already low values that we saw in Europe and the US. So, most investors that are in the game for a bit have probably heard that higher inflation and interest rates will have a negative impact on stocks. And in case of interest rates, that is definitely true for most sectors. When interest rates rise, the cost to take on debt will increase for companies and consumers. So credit cards and mortgages become more expensive and consumers have less money to spend, which then affects businesses even further. So this has a ripple effect on most sectors except banks and other financial institutions. But for higher inflation, the picture is not so clear. There have been several research papers on these topics, but the results did not always match. I don't want to dive too deep into the details here, but I put the links to 2 contradicting research papers in the description below, so if you want to read up on the details, please feel free to check them out. In a very general and broad understanding, we can summarize that the volatility of stocks is higher in times of high inflation, and value stocks tend to perform better. Growth stocks, on the other hand, tend to perform better when the inflation is low. The reason for the difference in performance between growth and value stocks is because value stocks typically generate higher cash flows with lower growth, whereas growth stocks have higher growth with lower immediate cash flow. In times of high inflation, the present cash becomes more valuable than future earnings as money loses its value rapidly. So exactly the stocks that have led to the outperformance in the last few years might be the ones that will have a harder time in the next ones. And because these stocks were the ones that performed quite well in the last few years, at least in my portfolio, they are also the ones that make up a larger portion of it. So the first and most obvious action to adjust our portfolios for the next decade would be to rebalance them and put a higher focus on value stocks compared to growth ones. But are stocks even the right choice for our investments anymore? Besides inflation and high interest rates, Ray Dalio identified several other differences compared to 10 years ago specifically for US stocks. Back then, we had a rare mix of low valuations after the financial crisis, strong growth combined with almost no inflation, corporate tax cuts in the US, and all this on a backdrop of increasing globalization. But today, the current landscape looks quite different. Valuations are notably high, geopolitical risks have driven the trend to nearshoring, and the Federal Reserve policy is significantly tighter than it was a decade ago. So it is much tougher for stocks to continue their outperformance today than it was a decade ago. All this has led Ray Dalio to lower expectation for stock returns. And he summarizes this in his paper like this. In the last decade, equities or stocks were expected to generate a moderate earning growth. For 10% of stock returns, the expectation for earnings growth was around 6%. This was beaten quite handily with even 8% of actual EPS growth. And the higher returns of around 13% we get with stocks do reflect this higher earning growth. But it is also extrapolated into the future, which led to higher valuations. With these higher valuations, US companies have to grow their EPS by 10% now to achieve the same return of 10% on the stock market. So if we look at it from the other side, if companies would continue to grow their earnings by 8% on average, the stock market returns would only be 5% given the high expectations that are baked into the valuation right now. And Ray Dalio argues that this is almost in line with the risk-free return of 10-year US bonds. And he's not alone with this expectation. Rathbone, the same guys from the UK that we talked about earlier, have basically the same expectation. They also anticipate the 10-year annualized returns for US stocks to be approximately 5% for the next decade. So when we compare this with the current yield of 10-year US bonds, it is currently at 4.4%, but we even saw yields of almost 5% earlier this year already. But that doesn't mean that we need to give up on stocks. A timeless principle of investing is that you don't need to predict the future. Instead, long-term investing is about preparing for a variety of possible outcomes. But still, Ray Dalio gives 10 instances since 1970 where global stocks fell by more than 15%. And for all of these crashes except the dot-com bubble, there were other assets that provided diversification from stocks. Bonds provided a steady yield and provide a cushion against the stock market. Inflation-linked bonds have a built-in inflation protection, and commodities such as gold also provide inflation protection while at the same time also help in times of increased geopolitical risks. Now, I understand the arguments from Ray Dalio, but I think we should question his intentions. And these are pretty obvious here. Ray Dalio is famous for his all-weather portfolio, and he even includes some advertisement for this at the end of this paper. This portfolio consists of 30% stocks, 55% bonds with different maturity times, 7.5% gold, and 7.5% other commodities. But this portfolio also has underperformed the market in the last 20 years, which is the longest time frame I can choose here. Of course, this was due to the exceptional performance of stocks in this time frame, so it might be different in the next decade. And his portfolio is also aiming to provide returns with a much lower volatility than stocks, which he handily achieved. So it is hard for me to argue against his logic. I mean, it is always very easy for a guy on YouTube to rant against top fund managers. But it is something totally different to achieve this performance by yourself or even construct such a highly advanced portfolio. Now, this channel is about stocks specifically. And while I like his research and argumentation, I was asking myself if there are any specific stocks or criteria that we can use to boost our performance. I have already mentioned the switch from growth stocks to more defensive ones, but again, the research from Rathbone digs a bit deeper here while using the same arguments as Ray Dalio. Here we see the rolling 1-year relative returns of the US against the rest of the world. Years where the graph is above the 0% line are years where the US has outperformed the rest of the world, while years where the graph is below this line show years where it was the other way around. After the dot-com bubble, for example, we had a roughly 10-year time period with consistent underperformance of US stocks. In the last 15 years though, the US had a very strong outperformance. One reason for this were the rising valuations of US stocks compared to the rest of the world that I have also talked about on this channel a couple of times already. In addition to this, the inflation in Europe is also lower than in the US, and the gap has widened even more since the US election. So when we look at our list of reasons again why stocks will perform worse in the next decade than in the last 10 years, for European stocks we can eliminate 2 of these points. So besides defensive stocks, European stocks in general could also help to boost the performance. In a very recent research from Vanguard that was released just 4 weeks ago as of this recording, they think the same. In their forecast on where to invest for the next decade, they think that the best place to be in are global developed countries without the US. Here they project returns of 7.3% to 9.3%. At the same time, they think that the worst place to be in are US growth stocks, where they are expecting returns that are even well below 2%. So their projection for stocks from developed countries ex-US is even quite a bit above the expected returns for bonds that are roughly in line with what we have seen from Ray Dalio before. So it might pay off again to be more globally diversified in the future. But there is one more thing that we have not talked about and that I was missing dearly in all of this research. And that is dividend and dividend growth stocks. In contrast to bonds, these companies start with a much lower yield but are growing their dividends on a regular basis. My latest portfolio addition, Novo Nordisk for example, which I just started a position in last week, has been growing the dividends with almost 20% per year for the last 5 years. If I would have invested in the stocks only 5 years ago, my personal yield on this investment would now be at 7.75%. And this just gets better with time. And dividend payments and dividend growth will not be affected by the high valuations that might lead to a slower price appreciation of the stock. Yes, it is true that in case of US stocks, you might have to buy them at a higher valuation, which gives you a lower starting yield. But I believe that you can still find great value in stocks that are not from the US. Don't get me wrong, I will not sell my big tech or US stocks as long as I think that the companies are still strong. And the valuation has already come down a bit from even higher values that we had at the beginning of the year. But as I am already overweight in US stocks, I think that it also doesn't hurt to get a bit more diversified. So I will continue to grow my position in European and maybe also Japanese stocks for the time being, and I will keep my focus on dividend growers as I already do. It might also be not bad to diversify at least a little bit in commodities like gold and maybe even bonds, but I'm still debating on this. But this is just my opinion. What do you think about this research? Do you agree or do you have a different opinion? I'd be really interested to hear your thoughts down in the comments. And while you're down there, if you found this video interesting and maybe even learned something, please hit the like button and subscribe to the channel so you don't miss out on my next video. As a small channel, it also helps me out a lot, so thank you very much. If you're now wondering what could be a good defensive European dividend grower, I have a video about a consumer staples company here that could grow the dividends by 9% per year for the last 5 years and that I am also already invested in. And this is no financial advice. So please, before investing, do your own research and only use this video as a starting point for your own analysis. That being said, thank you so much for watching guys, and see you in the next video.